right, well, welcome everyone. Thanks for joining us. My name is Lachlan McLean, a wealth advisor here at Equius Partners, and I'm joined by Alex Gangle, also wealth advisor here at Equius. And today we are going to be talking about equity compensation plans, incentive stock options, restricted stock units, employee stock purchasing plans. And really, this is the first part of a two-part webinar which we're going to do. Today we're going to talk about how you should evaluate your stock options and how it fits into your total financial plan. We're going to give reasons why it's a good idea to think about diversifying your stock options, reasons why you may not have already exercised or taken action to diversification, and then the scenarios in which you may want to hit the pause button or delay exercising your options and further diversifying. And then in our second part, we're going to talk about how to properly evaluate essentially the value of your options, and again, how that all fits into your plan. So two-part series. A little housekeeping. We are going to make the chat function available for this webinar. So if you have a question specific to your situation or about equity compensation plans in general, feel free to enter those questions. We'll have an advisor on the computer to hopefully be able to quickly respond to your question. And if it's a little bit more involved or nuanced, we may reach out after this webinar with a more robust response and hopefully get that answer you're looking for. So let's get started. Alex, you are a chartered financial analyst, a certified financial planner. Your educational background is in mechanical engineering, and you yourself you were an employee of a tech company which offered stock options and equity compensation plans. So you've participated in them, you've analyzed these types of plans, and now you advise on them. So you're a great person to have this conversation with. How do you advise and work with your clients, and we in general here at Equius advise our clients who are participating in these plans?
Thanks, Lachlan, for that introduction. Very flowery. Makes it sound like I walk on water, which I assure you I don't. But I have been part of these plans before, and I'm very familiar with them, working with many, many clients on helping them navigate their equity compensation plans. So the first place to start is we have to talk about, how much does this plan, does the compensation in your equity plan mean to you? How much do you have relative to the rest of your net worth? If we're talking a few $100s, a few $1,000s, that doesn't make up a large part of your net worth, then by all means, own your company stock, have some skin in the game, have fun with it, and get that sense of pride that comes with owning some of the action, owning the company that you work for. But, and this is the but, as your equity compensation, your stock ownership, your stock options, as they become an increasingly large part of your wealth, we're going, tens of thousands, hundreds of thousands. We've seen millions of dollars tied up in an employee having millions of dollars in a single stock.
Right.
That's where we're going to counsel towards diversifying that position in order to reduce risk.
And let's pause there, because let's acknowledge the fact that many of you may have joined this webinar not expecting us to come right out of the gate saying, great, you have an equity compensation plan, a stock option plan. We're going to want to divest from that or find ways to diversify. And the reasons why, which we're certainly going to spend a lot of time talking about, are really based in financial science. Regardless of how your company's stock has performed leading up to today, what's important as investors is how do we make or take the right steps today moving forward that put the odds of investing in our favor, right? And the best way I can kind of build that picture is if instead of your portfolio or your assets in your company's stock and your stock option plan, you instead had that money in cash, would you then go out and buy that same portfolio, buy your company's stock in its entirety? And based on what we're going to talk about today, the importance of diversifying, hopefully you come away with this saying, no, actually, I wouldn't, right? So let's talk about then ways in which someone can provide more diversification in their portfolio.
Yeah, absolutely. And to your point, diversification is key. And we'd say, the advice that your grandparents, your parents gave you is good. And when they said, don't put all your eggs in one basket, that's good advice, and it really applies here with respect to your equity compensation plan. I mean, history is littered with companies that at one time or another were leading companies in the field that have now either completely failed, they're no longer around, or they've failed to live up to lofty expectations. And now, some of these come from the history books, but just to name a few, you've got Yahoo, you've got Research in Motion, the maker of the BlackBerry, you've got Palm, MySpace, MapQuest, AOL, Nortel, Nokia, Netscape, Lending Club.
Right.
I mean, the list goes on.
Yeah, it's interesting hearing that list of names, list of companies. It's a bit of a time warp, takes you back. And the one that pricked my ears up is Research in Motion, BlackBerries, right? There was a time when BlackBerries were as ubiquitous as iPhones are today. And that's a good corollary, right? Because even a company, leader in their space in technology, cutting edge company like Research in Motion, they're just as susceptible to how markets work, how a company needs to continue to innovate and perform above expectations in order to provide a higher return to investors, right? And that's essentially what we're talking about is we as investors want to be able to capture the returns of the company, and that's what we're going to be seeking.
Right.
Yeah, and there's other names too, which the examples you gave are examples of really great, healthy companies who, for market share reasons, competition reasons, whatever they may be, weren't able to continue their lofty performance for investors. But there's other examples. Wells Fargo comes to mind, BP, British Petroleum, Volkswagen, companies that on paper looked like they were going to continue to be leaders in their space, but because of shady dealings behind the scenes that investors could have no idea was going on, those companies also failed to continue to perform like they had to. So there's all sorts of reasons why concentration risk in one stock or just a handful of stocks puts an investor in a very, very risky position.
Absolutely, and I think we have a great slide for our viewers today that really shows what happens as you increase the number of positions in your portfolio. So here we have a slide. On the vertical axis, we've got risk. And risk is simply how much your portfolio moves on a day-by-day, month-by-month, year-by-year basis, both up and down. It's volatility, and it's generally not something that people like to experience a lot of. On the horizontal axis, we've got the number of stocks in your portfolio. Beginning, as we move from left to right, we start with one company, and we start increasing that to 2, to 3, to 5, to 10, to 100, to 1,000. And what you can see is that as you increase the number of positions in your portfolio, as you increase diversification, the amount of risk in your portfolio declines. Now, something of interesting to note is that through diversification, you can reduce risk, and you can reduce it as much as possible, but you can't totally get rid of it. You're always going to be exposed to what we call systematic risks. These are risks that just pervade the market. A good example of that would be COVID itself. We've all experienced COVID. We know that back in February, March, stocks took a real hit in price, and it really didn't matter what your company did. So that would be a good example of non-systematic, non-specific risks, or I should say systematic risk, influencing the value of stock prices.
And another term for that is essentially market risk, right? And what's important about market risk, as you described it, is it's also what's described as compensated risk.
Right.
So risk and return for investors is tied at the hip. They're completely related. The higher the risk of your portfolio, the higher your expectations on return should be, right? But the type of risk matters. And the type of risk you're talking about, compensated risk, that's the risk we want in our portfolio, right? It's kind of the difference between good and bad cholesterol, if you will.
Exactly.
And so what we want to do through diversification is reduce, if not eliminate, those uncompensated risks, like concentration risk of owning one or just a handful of stocks, sector risk. There's a million different types of uncompensated risks out there. And really the best, if not only way to get rid of those uncompensated risks is through diversification, which is exactly what we're highlighting here.
Yeah, it's really the only free lunch in finance.
Sure.
It's something that gives you the same or maybe even improves your expected return, but reduces your risk.
And that's important. And that's really, really important. Now, let's acknowledge the fact that potentially some of our viewers out there might be saying, understand how financial science works, understand odds. I work for a really special company. We're going to hit on this subject pretty hard, but I work for a company, let's just say it's Apple or Tesla, really well-known companies, and we know how they've performed extremely well as of late.
Right.
But they think that that's a special stock that does not apply to general financial science. Yes. How would you meet that opposition?
Well, the opposition there is, first I would acknowledge that if you work for one of these phenomenal companies, And we've heard of FANG stocks, Facebook, Apple, Amazon, Netflix, Google. If you work for these great companies, and there's many more, those are just a handful of these large growth companies. You should be grateful. You work for a great company, great industry recognition, great working hours, great meals, great kitchens. The pay is good, the bonuses.
Healthcare plans.
Healthcare plans. You got equity compensation coming your way. So in a lot of ways, the company is special.
They're great for many, many reasons.
They're great for many, many reasons. However, and here's the however, in the eyes of the stock market, your company isn't special. The stock market does an incredibly good job of amassing all of the information that's known and even some privately known information, and taking all that information and distilling it into a stock price. And if you ever work for a really great company, what happens is that your company is going to get bid up in price so that the expected return going forward is going to be more staid, more average. And in fact, it might be that you work for a really great company and your expected returns are lower, which we'll talk a little bit about that later.
Yeah, well, let's hit on that point a little bit more, because I think it's a little counterintuitive to what you just said, that as a company grows and becomes a bigger, healthier, better company, that expected return is actually then decreased moving forward.
Yeah, you might think that because returns have been so great that they're going to stay that way, and if your company is large, it's going to stay large. But to that, we've got a couple slides that I'd like to show, beginning with the first one. Now, in this slide, what we have is the top 10 companies in America since 1930 at the beginning of each decade. And so back in 1930, you had AT&T, General Motors, General Electric, Exxon, Marathon Oil, DuPont. I mean, some of these companies, and there are others, Con Edison, Philadelphia Company, some we still recognize, some that are no longer around. And as we move from left to right, we can see that the leadership of these firms does change. In the 1990s, you had Big Pharma, you had Altria, Merck, Bristol-Myers Squibb were the top companies. And then in 2000, you had companies like Cisco, Intel, Lucent. I mean, you also had Apple and Microsoft. Sure. You have companies that are no longer in that top 10. So just being part of the top 10 largest companies doesn't mean that you're going to stay on top forever.
Yeah, and I think what this highlights is every company, no matter where you land on this spectrum, has strengths and opportunities, certainly, but weaknesses and threats as well, and that's never going to change. So again, concentrating in one stock is a very risky bet.
Right, and on the second slide, we're going to show, and I think this is very interesting for our viewers, is what happens to these companies after they've been promoted, after they've grown in size so that they're now part of the top 10 list. And this data goes back to 1927. It's from 1927 to 2019. And what we see is that in the 3 years, on average, after a company has made the top 10 list, the company's return, its annualized return over the following 3 years is 0.7% higher than the return of the stock market overall. That's actually a pretty good result, but does that return tailwind persist for these giant companies? The next bar shows the average annualized performance of those same companies over the following 5 years. So here we are simply increasing the measurement period from 3 years following promotion to the top 10 list to 5 years. Here the story changes. Instead of beating the market, the average return for these mega cap companies is negative 1.1% per year. This means that the average newly minted top 10 company has, on average, underperformed the stock market by 1.1% per year over the 5-year period following its promotion to the top 10 list. If you go out to 10 years, the results look even worse. The average return for the biggest 10 stocks over the following 10 years after making the list is negative 1.5% per year relative to the stock market average. So if beating the stock market was your goal, then an investment strategy that always invests in the absolute largest companies in America is not a way to do that.
Yeah, in some ways, they can still be good companies, good performing companies, but from an investor, they just can't innovate at the same rate that they had before, or they can't surprise the market in the same way.
Exactly.
And that gets back to the risk-return relationship, right? And that is that risk and return are related. The market does, I love this, this is a quote from you, the market doesn't reward safe bets, the market rewards risky bets, right?
Absolutely. The market rewards risk, and like you mentioned earlier, compensated risk. So when we think about these large companies, I mean, it's easy to think, well, look at the FANG stocks. Over the last 10 years, the average rate of return has been 34%.
Yeah.
That means they've doubled every 2.5 years. If I buy these stocks today, should I expect a 34% rate of return? And I'd say absolutely not. Again, if these companies actually had an expected return of 34%, there would be everybody would want to own them. I mean, a lot of people already do, but the buyers would flood the market, pushing up the price.
Yeah, the price would reflect that.
The price reflects that, which brings down the expected return.
Yeah, exactly.
Somewhat.
That's a great point.
Yeah, and so really what we find is that these large companies, these market dominators, because they are in such great positions, they actually are not risky companies to invest in. So you should expect, and this is what we've seen in the last slide, is that large growth companies, big companies that are low risk actually have lower expected returns than smaller companies and companies that are actually more average.
All right, well, let's assume we've done a really good job of showing the power of diversification here. There might then be the objection that, okay, great, you want me to go to a concentrated portfolio of one or just a handful of stocks. Now you're telling me I need to go out and buy a couple hundred, maybe even 1,000 or a couple thousand stocks in my portfolio. I don't have the time, I don't have the patience, and that's probably going to be pretty costly, right? So tell us why that is actually not a serious objection because of where we are in the industry today.
Yeah, there may have been a time where diversifying your portfolio to own thousands of stocks was very expensive, time-consuming, and costly. But now through financial innovation, we've got thousands of mutual funds and exchange-traded funds. Some of them are very well diversified. And with a single position, a single mutual fund, you may get exposure to thousands of companies. Now, here at Equius, we maintain a highly curated list of mutual funds that have tilts towards these compensated risk factors that we talked about, because we know that all mutual funds aren't created equal.
Right.
There are good ones, there are bad ones, there's expensive ones, there's low-cost ones, and you want to be in the right fund.
Yeah. And there's some other hurdles to overcome, certainly. And the first one that I can think of as an advisor helping clients work through this is, the reality is these equity compensation plans are very, very complicated. Not complicated in general. Each company has its own plan, and each employee has their own specific plan depending on where they are in the hierarchy of the company, right? So it takes someone who deals with these plans and deals with the mechanics of these plans almost every day to be able to decode and decipher them. And then once we have that figured out, because there's restrictions on timing and what actions we can take, taxes and a lot of other things, we then have to interpret how those plans fit into a total financial plan, right? So there's a lot of balls in the air. There's a lot of things in motion that have to be accounted for with these plans, right? And some other ones.
They are complicated, and that's probably that we often see that just the complication of it being a reason that's keeping people from making the right moves to diversify their portfolio, to exercise stock options and sell stock. The other one we see is taxes. It's just having to pay a big tax bill when you sell highly appreciated stock or stock options that are deep in the money. You know that a big chunk of your net worth is going to go to taxes. Yeah. And to that, we've advised our clients constantly about this, is don't let the tax tail wag the dog. We've seen too many times people not making the right decision to diversify their concentrated position in their company, only to see their stock price fall and not making that move because they didn't want to pay the taxes, and they end up in a worse position with a lower stock price than if they had just paid the taxes and diversified their stock. Yeah. So taxes are a big one, and it's important for our viewers to remember that when you exercise your options, when you sell your concentrated stock, yes, you're going to be paying taxes, but not doing so, you're not avoiding taxes. you're just delaying taxes into the future, which is far less value. Now, what is the value of delaying taxes? I mean, there is value to that. And that's, the fact is when you pay the taxes, you're giving up other people's money that you could be making money with. You're paying the IRS. Here in California, you're paying the Franchise Tax Board. And that's money that you could have otherwise invested in your company's stock that perhaps has a positive expected return. So you are giving up some gain, some growth by paying those taxes early. But we would say that the diversification benefits, the risk reduction benefits of having a more reliable future for you and your family is far worthwhile to pay those taxes.
Certainly. And much of what we've covered so far is kind of the hard sciences of financial science, how the numbers play out and very tangible things to consider. But we as advisors know that's really only half the story, right? How the numbers play out is half the story. Helping a client emotionally, we as human beings, the softer side of things, accept this information and take action is a whole nother thing. And to that, I say in this scenario with equity compensation plans, there's a couple of cognitive biases that we are often confronted with that we have to help counsel our clients through.
Right.
A couple that come to mind, there's a status quo bias and a regret avoidance bias, right? And what those mean is status quo bias is, here you're an employee of a company, you're granted these options, everything's going well, a body in motion stays in motion. So to make a change means, having to take action, having to do something differently, right? So that's a hurdle that we have to overcome.
Yes.
Regret avoidance bias is simply that, with any decision and investing as well as anything else, there's always going to be the possibility that the outcome could be negative, right? So we as human beings are hurt more emotionally if we took action that resulted in a negative outcome versus, let's say, you didn't take action and the negative outcome happened. At least we felt like, well, we didn't do anything to cause that, right? It was out of my hands. That's easier to swallow than if we did something and achieved a negative outcome. So that's a hurdle. And then there's simply something that I like to describe as the endowment effect, right? And that's, if you are granted these options and you own that stock, it's your company stock, it's your stock, the endowment effect says that you place a higher value on that stock than really anyone else does, right? It's kind of like this pointer right here.
It's a beautiful pointer.
It's a beautiful pointer, I will admit. However, the value I place on this pointer is probably higher than if someone were to go to Staples and buy it, right?
Because it's your pointer.
We've been through a lot. We've been through a lot of presentations together. So I would charge a higher price than Staples would for this, and it's simply because I own it. It's my pointer, right? Same thing with stock options. It's hard to get people to want to think about selling it because they have a relationship with it.
They do.
Yeah, and there's a few others.
Those are really good ones. A couple more that come to mind, especially for, if you're an employee and maybe you're in upper management, you have a good pulse on the firm. So you think that you think you can sidestep market movements, but there's a couple biases that are known in the literature as illusion of knowledge, illusion of control. And that's this idea that because you're so close to the company, that you feel like you can impact the results, the returns of the company, or that you could sidestep a market correction. But as we talked about before, the market is way smarter than any one person, and does such a good job of taking this information and setting prices. But the only thing that really changes the price of a stock is the unexpected surprises. Right. And how do you prepare for an unexpected surprise? You just can't. You can't. So be aware of illusion of knowledge and illusion of control.
Yeah, and what I like about those examples is we can highlight very specifically and tangibly that effect, and that simply be, CEOs have their own divesting plan, right? And most of those are publicly available. You can look them up, where CEOs understand the power of diversification, understand even though they have as much control as anyone does on the performance of a company, right? But they still understand they don't have total control. So what they want to do is become more diversified. They want their net worth not to be concentrated in just their company. And so what happens is a lot of CEOs get together and pool their company, their stock options and their stock, so they can share and diversify their portfolios with each other because, again, they understand the power of diversification, why it's important. Yep. So let's talk about then, as we alluded to, that there are some reasons why someone then wouldn't exercise their options immediately.
Yes. So we don't want our viewers to leave this webinar, and this is not a a wholesale recommendation to hit the sell button as soon as you leave this webinar for, exercise all your stock options and sell all your stock. Because there are reasons that you might want to hold on to, and they may not be the reasons that you thought of, but they are real valid reasons. And one of them comes to mind is sometimes there's tax implications, tax benefits for delaying selling stock. And a good example would be when you're dealing with incentive stock options. You're granted incentive stock options. They're a special type of stock option. And if you hold your stock at least 2 years from the grant date and 1 year from the exercise date, you're going to get preferential tax treatment of the gain. You're going to pay taxes as if these were capital gains versus high tax ordinary income. So if you got a year or 2 years to go before you meet the holding period, well, you're taking a lot of risk by delaying. But what if it's only a month away you've met your holding period, or 2 months away? You've held on the stock this long. You might want to roll the dice a little bit, stay concentrated for another month, another 2 months to reap the tax benefit. I mean, again, there's still risk in doing that, but you need to weigh the pros and cons. Another type of stock, type of grants that you have to be careful that you don't want to exercise would be stock options that have many years to expiration. Usually an employee stock option has a expiration date that's 10 years away from the date of grant. And options that aren't very deep in the money. Say you've been awarded stock options at a strike price of $10, and now the stock is trading at $11. So you've got $1 of gain in that option. And let's say those options don't expire for 10 years. Now, if you could take the intrinsic value of that option is worth $1. But if you could sell those options on the open market, you can't. You can't sell employee options, but options do trade on the open market. An investor would pay you a lot more than $1 for your option, because what's embedded in there is what's called time value. And that's the opportunity that over the next 9 years that the stock will rise and it'll bear out that the option's worth more. And people are willing to pay on the open market for that. So if you exercise a stock option that's not very deep in the money with many years to expiration, you're going to end up destroying a lot of time value. And we would say those are a good example of options not to exercise.
Yeah, and that example and some of the other ones, we're going to get a lot more into detail on the second webinar that we do, the follow-up webinar. So I think what this really highlights is that, again, each situation is highly, highly specialized. And it really helps to work with someone who knows how to evaluate this sort of thing so they can give you a recommendation and, again, roll out a plan that involves these options.
That's right.
And I would just also offer up, while the messaging has been in general, it's a great idea to diversify, to divest from your stock options at a certain point when it makes sense. We have to recognize that we understand that there is still intrinsic value in these options. So again, in the right situation, we would absolutely understand wanting to hold on to some of them or continue to participate in stock purchase plans and still want to, again, participate in your company and the performance of your company. So we understand that, but our recommendation is really for money that matters, that you need reliability around, money that needs to be there for your financial future. It's important to use prudent investing practices for that type of money. And again, you can always have an account on the side so you can still participate in your company's plan. Yeah, absolutely. So let's, we're coming up on time, so why don't we just summarize real quick, maybe 3 points to take away from this webinar that will help lead into the second.
Sure. If I were to summarize the main points from this webinar, I'd say number 1, diversify. Don't put all your eggs in one basket. The overarching theme, we talked about some special cases, but the overarching theme is to diversify away, reduce risk. Your company isn't special in the eyes of the market. 2, this stuff is complicated. We'll say it again. There's a lot of nuance. You need to understand the financial implications of the decisions you make. You need to understand the tax implications of the decisions you make. If you don't understand them completely, then definitely align yourself with a financial professional, a financial fiduciary, someone who's going to make decisions that are in your best interest only. And 3, I'd say tune into our next webinar, where we're going to go deeper into how do you value these options, what you should be should you exercise your options or should you sell stock if you own both? Order of operations. So we're just going to dive a little bit deeper into the mechanics.
Yep, perfect. All right, well, thanks, Alex. And thank you all for joining. Hopefully this information resonated with you and, stimulated the interest in wanting then, now that we've talked about how to value your equity compensation, then how we talk about the mechanics and the right way to exercise them. So stay tuned. And again, thank you for joining.